3-minute trader tip. Trading a new instrument, beware the 4 dangerous assumptions. It is worthwhile emphasizing that although many things are transferable when looking at new trading instruments, there are things to be aware of. Quite commonly, when we have the opportunity to trade a new instrument, let's say, for example, we've been trading Forex and we move on to indices, or even we've been trading one index and we decide to add another, commonly traders do not do as well as they hoped. One of the key reasons for this is because that there is often an assumption that because you have experience trading one instrument, that all you know is immediately transferable. And although it is true that much is transferable, if you don't take into account the idiosyncrasies of trading a new instrument, you are increasing your trading risk. Because of this, we put a short video together to just outline 4 things that you need to be aware of. Assumption 1 is assumptions in pricing. There's obvious difference in pricing between, for example, share CFDs and FX. But note also there are very significant differences in pricing when looking at different commodities. So, for example, the way oil is priced is very different to copper. Even within indices, if we look at the way the S&P 500 is priced, it's different to that of a NASDAQ or ASX 200. Assumptions in system is the second dangerous assumption to make. You may have found a system which works very well trading one particular instrument, but it is dangerous to assume that it will work equally as well on another, even within the same instrument again. This is due primarily to the different ways different asset classes move. Let's give you a simple example. If we look at indices, there are very significant differences between the way the DAX moves and the FTSE. Even within FX, there are some pairs which are fairly well correlated. For example, the Aussie dollar Kiwi. This will move very different compared to perhaps the GB pound yen. So it may be your system works on one, but not so well on another. The third assumption is an assumption of price movement. Different things will have different effects on different asset classes. An obvious example is an interest rate decision. This will generally, if hawkish, be positive for a currency, for example, the AUD/USD, but will be negative for a different instrument, for example, any stock on the ASX. The fourth assumption to be aware of is assumption in timing. There are times during the day when liquidity and spread are very different depending on the instrument you're trading. Another prime example would be when trading indices, where the index CFD has more volume traded when the actual underlying index is open. So, for example, the ASX will have more volume generally and be more frequently traded on the ASX futures CFD contract during ASX market hours. So, the overall message here is to do your testing in each of these areas at a small trading level before scaling up to your normal trading level. Test these assumptions out, and of course that puts you in a stronger position to manage the risk of specific trading instruments. Trade safe, and we'll see you again soon. Bye bye for now.